Welcome to the Real News Network. I'm Paul Jay in Washington. As 2011 comes to a close, the central story, of course, is still the global economic crisis. The European Central Bank has just announced that it's starting a loan program that will allow private banks in Europe to borrow money at about 1% interest, and apparently almost $500 billion now has been borrowed. This is supposed to create some impetus in the private banks to buy government bonds, which in theory helps alleviate the euro crisis. The question is, does this get to the roots of the crisis? And if it doesn't, what will, and what might we be expecting in 2012? Now joining us is an eminent panel to discuss this issue. And first of all, Bill Black. Bill Black is an associate professor of economics and law at the University of Missouri, Kansas City. He's a white-collar criminologist, a former financial regulator. And he's the author of the book, The Best Way to Rob a Bank is to Own One, and he joins us from Kansas City. Also joining us is John Weeks. John is a professor emeritus at the University of London School of Oriental and African Studies. He's the author of the book, Capital, Exploitation, and Economic Crisis. He's been an advisor at the United Nations Development Program and the World Bank, and he joins us from London, England. And also joining us from Bologna, Italy, is Paolo Manassi. He's an economics professor at the University of Bologna. He teaches macro and international economic policy. He's been a consultant for the OECD, the World Bank, the Inter-American Development Bank. He's been an advisor at the IMF. Thanks for joining us, all of you. Paolo, let me start with you. This loans and what they're saying, introducing this big whack of liquidity into the European financial system, is it going to work? Does it actually address the roots of the problem?
Okay, I don't think it will address the roots of the problem, but it will address the last incarnation of the crisis. The last incarnation of the crisis that we imported from the U.S. and then it became a sovereign debt crisis. The last incarnation is a banking crisis and a liquidity crisis, which is very serious. What is going on in Europe in terms of banks is that banks are unable to basically borrow from the international market and to place their bonds, their obligations. So in fact, there were a number of auctions that were quite unsuccessful in Europe. And next year, it's about banks will have to borrow something like 700 billion euros, so large amounts that nobody knows how these banks will be able to get. So now we are in a situation in which there is a lot of uncertainty about the balance sheets of banks, because most of them, for example, Italian banks, are full of sovereign bonds, which are shaky, and so banks are very reluctant to lend to each other. So we have a almost frozen banking situation, very similar to what happened in the U.S. with the subprime crisis, and this explains the very large intervention of the ECB with this opportunity to borrow from the ECB at very low interest rate, 1%, in very large amounts for 3 years. So this new measure are addressing the last incarnation of the crisis that is a banking crisis after the sovereign.
John, what's your take on this? Because in the United States, where the IMF the Fed gave all these low-interest loans to banks and big corporations, to a large extent, they're kind of sitting on the cash. It may have made their books look stronger, but it hasn't done much for the real economy.
I think that the central bank's action is ridiculous, because think about what they're suggesting. What they have done. They have lent money to private banks to buy government bonds throughout Europe. Why don't they just buy the bonds themselves if they want bonds bought? The reason they don't is purely ideological. Merkel and others and the leaders in the European Union will not allow the Central Bank of Europe to be a central bank and be the lender of last resort. That is the problem. So the second problem is that even if the bonds were bought directly by the Central Bank of Europe, or those banks were to feel generous and they were to do it, that would not solve the problem, because you would get the debt generated afresh, because the problem is essentially imbalance in trade. Germany has a huge trade surplus. That trade surplus is balanced by the deficits of the other major countries and minor countries in the Eurozone. And until that problem is solved, it will be difficult or impossible for the countries that are in trouble to get out of trouble.
Bill, you can talk a little bit about the American experience with this kind of Fed introducing liquidity into the U.S. system, and and also what do you think of what's happening in Europe?
Well, I agree with John, and indeed he has described this as the new mercantilism. And that, of course, is exactly what Adam Smith was writing principally about, the insanity of everyone trying to out-export everyone else, which is a policy that can work for a few nations, but is catastrophically bad for the world, and therefore ultimately bad for all of the nations. What you're seeing in both America and Europe is a complete willingness to bail out banks, but not human beings. And that is what has pushed the Eurozone, according to the OECD, back into recession already. And as we're having this discussion, Republicans are threatening to put the United States back in recession by ending the payroll tax reduction.
So, Paolo, what do you make of the argument?
Well, let's say I agree on the substance, a little bit less on the how can I say, on the ideology, in the sense that I don't believe there is anything to do with mercantilism, frankly. But it has to do with trade, though. So what happened is that productivity growth in Germany, grew, was very high during the last 15 years. In many countries, for example, Italy and other southern European countries, we had almost no productivity growth. This is true, for example, for Greece. This is true for Italy. This is true for Portugal, for example. So what happens is that this divergences made relative prices change in such a way that the goods that were produced in Germany became much cheaper relative to the other goods. So this brought with that a trade surplus in Germany and a trade deficit in many of these countries, less so in Italy. So it was something that had to do with the real economy, not with the politics in a sense, or kind of not with the trade policy, tariffs and the sort of things. The problem was that having a single currency managed to kind of increase this problem, because the nominal exchange rate could not adjust. So typically what happens is that countries running surpluses have their exchange rate appreciate, and that offset the change in relative prices. This could not happen with a single currency, so we had the persistence of this trade deficit. So I agree on the substance. The substance was the divergence of productivity growth leading to trade imbalances. That was not an explicit thing made by the evil guys in Germany. That was just a result of very sane productivity growth and very insane productivity stagnation in other countries. But the result was surely a trade imbalance.
Well, John, there's two parts to this argument. One is the role of Germany. And is this to what extent is this sort of a structural but also deliberate policy on the part of Germany or not? And then the other part is the piece that Bill raises, that this seems to be about bailing out banks while there's austerity for the real economy.
It's a complicated question, which I'm going to try to make simple. And the way I'm going to do it is by, let's look back at 2000, 11 years ago. 11 years ago, Germany had a slight trade deficit of about 50 billion euros. And all the other major countries of the Eurozone had about the same, slight surpluses, slight deficits. In the subsequent 10 years, Germany has generated a surplus of over 300 billion euro, and those other countries have generated a deficit almost the same size. Now, I don't see that is the result of any inherent structural relationship between Germany and those other countries, except for the economic and political power held by Germany. It's one issue. Also, another very related issue, 2007, in 2007, who had the smallest budget deficit? Well, actually, Spain, who was running a surplus. Who was number two? Portugal, who was running a deficit of about 1.5% of GNP. Who was third? Germany, almost exactly at the Maastricht criteria of 3%. So just 4 years ago, Germany was not the most prudent and solvent-looking country in Europe. It was at best number three. But now Spain and Portugal are in a terrible situation, and Germany's lording it over them. Why is that? That relates to the restrictive fiscal and monetary policies followed by the German government in the last decade, when they should have been following expansionary policies. They should have followed expansionary policies, which would have increased their rate of growth, which is relatively modest, which would increase the exports of the deficit countries, and we wouldn't be in the situation that we're in now.
Paolo, I'll let you respond. I mean, essentially, I think John is saying this is a beggar thy neighbor policy coming from Germany.
I think there are two sides of the questions. One is the trade surplus and deficit of countries, and here I think nobody knows where it comes from. I mean, what we observe is that prices grew much more rapidly in southern European countries, and productivity grew much less rapidly, while in Germany it was the other way around. So productivity growth was very buoyant and prices were kind of stable. So that was a clear competitive advantage, and any economist would have predicted that should have resulted into a trade surplus. So this is part of one argument. Then we have another issue, which is the kind of what is the role of the budgetary policy in the crisis. And on that, I do agree that the budgetary policies which Germany is kind of focuses on, and which it's totally obsessed by, is not the real cause of the problem, because as John correctly said, Spain was a kind of one of the most virtuous countries with running surpluses, and even Italy, despite the big debt, was kind of running modest surpluses. But Germany and France, they actually reformed the Growth and Stability Pact to make it more relaxed, because they were running surpluses and that they should have adjusted. That happens about 3-4 years ago. So the real issue was not, the real cause of the problem was not the budgetary situation. What happened, at least in Spain, Portugal, and Ireland, in Italy and Greece, things were different because of deficit in Greece and because of debt in Italy. And that, for those two countries, the budget played much larger role. But what is sure is that with the crisis that we imported from the U.S., the big recession, that boosted the budget deficit all over the place. And now the German obsession with cutting and cutting and cutting is becoming very risky, because I agree with what John said. The point is really about having different policies for different countries. Now, there are countries which are either already bankrupt, like Greece, or close to becoming so, like Italy. And this country have little choice. I mean, they have to do some consolidation, possibly not too tough, but with such high interest rate, they have little option. But however, there are other countries like Germany which are running trade account surpluses and have relatively sound budgetary position. And I agree they should really expand, and that would take care of a lot of problems of low growth in the south, problem of current account deficit in the south. So what is sure is that now we should have different policies for different countries in Europe, and not what Germany is imposing on everybody, having everybody tighten up at the same time, risking aggravating the global recession for everybody. So on that, I do agree.
Bill, President Obama last week, when he was addressing the crisis in Europe, he said there's plenty of money there. If they wanted to deal with it, they could. It's kind of ironic, because one could certainly say the same thing about the United States. But you go back to your point about it's about bailing out banks and not people, meaning, I guess, in terms of growth in the real economy.
The new credit facility provides exceptionally low-cost funds to banks, well below supposed market rates, and it's a way of transferring wealth to the banking sector. And I agree with both of my colleagues. There's absolutely no reason to do it this way except ideology about the role of the ECB. Obama is correct that Europe has more than ample funds to deal with the crisis, but it has allowed it to twist slowly in the wind, and it has exposed the fact that the leading proponents of ever closer union, France and Germany, didn't really mean it. In other words, once Greece got in trouble, well, it was the damn Greeks that got in trouble. It wasn't my fellow countrymen analog in the United States, say when New Orleans has a hurricane, you bail out Louisiana, whether or not you particularly like Louisiana. But Europe is not a united nation. It's not close to a united nation. And Germany is imposing policies that are exceptionally destructive to the rest of Europe. And so ultimately it is completely ideologically driven. You have insanity, after all, going on, where if you go to Ireland, the official policy mandated by the rest of Europe is to cut your wages so that you can out-export the Portuguese. But if you go to Portugal, the strategy is to slash working class wages so you can out-export the Irish. And this is the road to Bangladesh strategy. And it is quite clear that France, Germany, Netherlands are quite willing to saw off the periphery of Europe. They just can't figure out a way to do it without hurting their own banks.
John?
Yeah, I agree with Bill. And let me say, Paolo and I are quite close on this too. There are a few, I think, interpretations that are different. That we may have time to come back to, but I want to deal with what Bill said. I think first on bailing out banks and not people. I mean, the obvious one is mortgages. I mean, it's such an easy way to stop these predatory foreclosures. Such an easy legal way. All you would have to do is for Congress to pass a law that said before any bank could foreclose on a household, they would have to prove that the household could not pay. And you could have strict guidelines about, if you were unemployed, you qualified for you couldn't pay, and so on. It would not be difficult to do that. We've done that and other things. But instead of that, we have, a Rube Goldberg bill to try to help people with their mortgages. It doesn't work and doesn't have enough money. And so that's a clear example of how you bend over backward for the banks, but you put something that's, really second rate and doesn't work for mortgage holders. And also, I want to very briefly just say something what Bill said about cutting wages. It's true. About a month ago, I wrote a article called "The Italian Workers Caused the Italian Crisis." I mean, where the argument is, wages are too high, benefits are too great. I mean, it's really annoying about human beings, isn't it? They expect to, they grow, they continue to live after they quit working. If just people died when they were 65, we wouldn't have this pensions problem. And, I mean, this ideological assault on everything progressive and everything to do with the welfare state. I mean, the message being pushed by the right in the United States and in Europe is it's a welfare state that caused this crisis. That's the problem. We just get rid of it. We'll be okay.
Paolo, what do you make of this argument that this is all about saving the banks, whether it's putting liquidity into the financial system or it's imposing austerity policies on people of Europe, that this is really about strengthening the bank's bottom line without too much regard to what happens to the people of Europe?
Well, I agree that even in Europe, all this money given to banks are kind of raising a lot of doubts, and nobody likes banks anywhere in the world, and in Europe, banks are not loved as they are not in the U.S. Let me say something, however, and that may explain, despite that, the fact that banks are being bailed out. And this, unfortunately, I mean, for the way in which our system is built, has to do with the key role that banks play in intermediation, so just transferring money from savers and households to firms. Now, this is intermediation, and like in the U.S., in Europe, the role of banks is much larger in financing firms than in the U.S. In the U.S., firms go to the stock exchange market. They get the quotes, and then they raise funds from the stock market. In Europe, this happens to a much smaller extent. In particular, in Italy, for example, it's very small, and therefore, if banks fail, what this means is that this has a number of domino effects on the economy, not only on banks, who cares about banks, but if banks fail, then depositors will not be able to get their money back, so households will not be able to get their money back, and firms will not be able to get their credits, and then they will shut off, and then we'll have mass unemployment. Yeah, we'll have a joint debt and banking crisis in the same way we had many in the past. I mean, just from Argentina being the obvious examples, but that's there are scholar articles about crisis of banking and sovereign debt crisis, and the evidence that we have is that when we have a joint debt and sovereign debt and banking crisis, that's the worst that can happen to the economy. Unemployment goes through the roof, and we had poverty, and at least for 2 or 3 years, we really have very bad situation. So I think this is the worry that explains why a lot of money is put to the banks. Clearly, there should be much more constraints. I mean, there would be a credible threat, for example, of the ECB to use this money not just to kind of, get a fat profit by, this carry trade. You borrow at 1% and you invest at 7%, but to lend effectively this money to firms which are in very shaky position. And the threat would be either you do it or, will not renew this credit line. So there must be a way in which to make sure that this money gets to the economy. And about the ideology of the ECB, if I can just make a final comment, it's true that there is a huge ideological factors here, such that the ECB doesn't play its proper role of lender of last resort, as the Fed does in the US. But you really have to remember that the ECB is basically the result of a compromise in which the Germans accepted this joint currency and accepted to give up their beloved Deutschmark only if the new ECB was very, very similar to the Bundesbank, and only if in its statute there was written, in gold and on the stone or whatever, the law that it would prohibit financing, budget deficit by the central bank. So it's now, in the times of crisis, this rule is crazy, but you have to understand where it comes from.
Right, John, if I understand it correctly, most of the money that's being borrowed by the European private banks is going to actually be used to pay loans that are coming due in 2012 and maybe buy some bonds from some of the European countries. Very little of it is actually expected to go into the real economy as loans to businesses and such. So I mean, it raises the question: is the private banking system essentially broken? Is this just an endless pit? And does there need to be some alternative to it?
Yes. Well, I think that what Paolo says is quite true. I mean, banks in a market economy, a capitalist society, need banks. I would have done what the Swedish government did in the early 1990s. I would have nationalized them all. That was not a social democratic government that did that in Sweden. That was a conservative government in Sweden. Now, then, I think they were rather foolish. They sold banks back to the private sector. They should have kept them. They should have kept them in public sector. But that is the only seems to be reasonable solution to this problem. What should have happened is a year ago, the Central Bank of Europe should have bought all of the Greek debt. It would have been easy to do. It's like 1/1000 of the assets of the Central Bank of Europe. Germany would have embarked on an expansionary policy, and we would not be in this problem now. We wouldn't have the speculation. You could impose austerity on Greece if you wanted to after doing that, and it would be less painful because they wouldn't have the debt overhang. But it didn't do that. So what what they did is they just kept putting the solution off, and I think it's because, to a great extent, the German government, first of all, it's led by very short-sighted and small politicians. We're a long way from, the Adenauer's right wing as he was, and much less Willy Brandt. And they're afraid to abandon their export-led growth policy. It was a problem when the world economy was expanding. It's a disaster to pursue export-led growth when the world economy is contracting, as Paolo suggested and as Bill suggested.
Right. Paolo, what do you make of that? They should have just, and maybe still should, just nationalize these banks rather than pour more money into them.
Yeah, I mean, in theory, I think the Swedish solution was the right one, but we are in a much worse situation because at the time the Swedish state were sound, and were no doubt was not a sovereign debt crisis in Sweden. In Ireland, what happened is that the government in Ireland just basically bailed out, or and gave guarantees to banks, and that worsened and transferred a lot of money to banks to either to buy them up or to transfer the money, and as a result, the state went bust. So the difference between Sweden and Europe now is that Europe now is in the middle of a huge debt crisis, and so that they don't have the money to nationalize the banking system. So I think this option, which was in theory available a few years ago in Sweden, is simply not available any longer. So things are much more difficult.
Bill, last word to you. What do you make of some form of public banking system as the only perhaps effective solution to all of this?
Well, first, let's get real. The intermediary function, which means the banks are supposed to get money to finance productive purposes in the real economy, broke completely. The banks did the opposite. They provided funds to the least productive activities, the most fraudulent, the most bubble creating. Second, people in the streets may not like bankers, but people in high government love bankers, and they love bankers worldwide, and they do tend to listen to them quite heavily because they're a leading source of political contributions, but also, as my colleagues have mentioned, in Europe and in Japan compared to the United States, there's vastly more dependence on banks than on the general capital markets to get funds. Third, Kina, there is no alternative, is the great ideological disaster, coupled with the concept that there was something virtuous about not running a deficit. The United States has run deficits roughly 93% of every year. And it's had its greatest growth opportunities when it's had deficits. When it has attempted to contract and end deficits, it has been followed in every case by a depression, except this case, which is a mere Great Recession. So whether or not you nationalize the banks, you assuredly should take insolvent banks and close them and reopen them the next day, which is what we do in the United States routinely in the savings and loan crisis. It's called a pass-through receivership. And that option is fully available. It will keep the economy going, and you can choose your national policy on public versus private or some mixture. But the current system is broken. Ireland is broken because de facto it sought to bail out the German banking system. And there's a small scale problem in terms of the size of the Irish economy versus the German banking problem. So the euro is fundamentally flawed as it is set up. The ECB is fundamentally flawed as it is set up. Yes, we all understand the historic reasons why it's screwed up, but what a population needs to do is adopt some degree of pragmatism and learn when events have changed. And so the boogeyman is not hyperinflation. We should be so lucky as to have 2 to 3% inflation. That would actually be helpful in recovery. So right now, everything in the system, the so-called Stability and Growth Pact, the single currency, and the single interest rate, and are conspiring to make sure that the periphery cannot recover and will be locked in long-term recession with sharply falling real wages for the working class. And that is what just tipped them back into recession. And according to the OECD, is taking the entire Eurozone back into recession. And we haven't mentioned it, but the Brits, Cameron, is also very bad on this ideological ground.
Thank you all for joining us, and we'll do this again. You clearly can't unravel all this in one session. So early in the new year, I hope we can go at this further and maybe focus more on what possible solutions there might be. So thank you, gentlemen, for joining us, and thank you for joining us on the Real News Network.